welcome to my channel. This is Forex Analysis Hub. With who? With Peanuts. Guys, please give me your ears, give me your mouth, because you cannot talk to me. Just make sure you comment down below. Make sure you comment in any queries. Now today, it's a good day. Now today I'm going to show you this a lesson. I'm going to show you a strategy that is used by many people, and it's the easiest strategy that we'll ever use in Forex. This is the easiest strategy that we'll ever use in Forex. Now today I'm going to show you something called supply and demand. What is supply? What is demand? Now let me show you what is supply, what is demand. Now today's topic is supply. Let me write here, supply and demand. Strategy. Now in this lesson, guys, I'm going to show you what is supply and what is demand. In the local terms, we can say that supply is where the commodity or any goods that are in surplus. So when the goods are in surplus, they are a lot. That means the price goes down. That is the supply. Means the supply is higher than the demand. And then the demand is where the goods are low. They are very low. That means that is a demand. And demand and supply strategies is used in Forex, is used in gold. You can use it in Euro, USD. Anything that you are trading can be your supply and demand. You can use this strategy to know where to enter the trades, where to exit the trade. Now, in this supply and demand, I want you to understand there are 5 key things that you should know in surplus. Number 1, the first one is you should know what is supply and demand. Okay? The next thing you should know is how to identify supply and demand. Okay? The next thing you should know is when to enter the trade. When to enter the trade. Am I going to sell or am I going to buy? Depending on, is it a supply or a demand. The four main thing you should know is high and low quality zones to enter the trade, because you don't want to enter a trade when it's in the middle. You don't know if it's going to rise or it's going to sell. This is not gambling. This is using strategy. Now the 5th thing and the last thing is why only some zones works. Okay, those being the five quality things you should know. Make sure you have written somewhere down in a paper, because these are the key points that will help you understand. This is demand. I'm sorry I confused there. Now let me ask you, because you have know what is supply and demand, how can we know what is supply and demand in the graph? How can we know that? How to identify, is it a supply or is it a demand? How can you identify? Now the best thing to identify is you use these key points. The first one, I'm going to show you guys the first key point. The first one, to know how, let me ask this question: how can you know how can you know supply and demand? How can you know supply and demand? That is the question I'm asking. How can you know supply and demand? The first is using key levels. That is resistance and support levels. That is where you can know if it's a supply or it's a demand. The second thing you should know is where there is a strong rejection. This occurs many times, around 90%, where there is a very strong rejection of a candlestick. Mark you, use a candlestick of 1 hour time frame and above. Don't use 30 minutes time frame and below, because they are very, very noisy. So the best candlestick you can use is 1 hour, 4 hour time frame, and a day time frame. That is 1 hour and above. The third thing that will help you identify where is the supply is the momentum. It's called the momentum spike. The momentum spike. This is how can you know if it is a supply or is it a demand. These are the key points. Make sure you have written somewhere, because they will really, really help you. Now, before I delete them, I want you to write them somewhere, because I want to delete them and get back to work so that I can show you how you can do them. Now, using the key levels, that is the resistance and the support levels. Let me first remove these things. If you have not written, you can go back to that video and not remove this one. Now, the first thing you should know is the key resistance point and key support points. You know, history of trading repeats itself day and day and day and day. What the trade did 10 years ago, it can do it right now, and it can do it in the future. So this is a strategy that will really help you. Now let's go. The first point is resistance and support levels. How can you know if it is a resistance or is it a support level? Resistance points are the highest point a trade went before going back. That is a highest point a trade went before consolidating or recessing or retracing back. Now we can use these levels. Let me show you guys. This is the highest point a trade went. So this candlestick will be our resistance level. You see this candlestick? That is a resistance level. Where the candlestick went, yeah. Sorry for that. These are resistance level. That is at the resistance level. But remember, a trade can break a resistance level. You see? And then a support level is the lowest place a trade went in a particular time frame. If this I'm using is a 1 week time frame, this is the lowest point the trade went. I'm analyzing for gold. Now this is for gold. That is the lowest place at time. And then there are many small support levels which are not very strong, and many resistance points which are not very strong. Because we can see this is the highest point that time it went. So that will be another resistance. Yeah, that is another resistance. And then here we have another support. You can see this is another support. And I want to show you history repeats itself. Is that another support? Here it's also another support. Let me charge my laptop. I don't want you to lose anything on this topic. This is a very serious topic. Make sure you understand it. This being a support level, this is another support, this is a resistance, this is a resistance. Here we also have here, around here, let me show you. Let me use another thing. You can use a brush. This around here, that is a support. Here we have another support. You see, the lowest place a trade went, that is a support. So identifying supply and demand, you can buy at support levels and sell at resistance levels, because the resistance level is also called a supply zone. This being a supply level, you can sell here and wait for the trend to go down and down and down. This being the strategy of using support and resistance, it is not very 100%, because it can break a support or it can break a resistance. Because for example, this was a support zone. The trade went bearish. Bearish means it went down and then tried to recess and then bearish, went to these support levels and then went up, broke the support levels and went down, making another support level. So this can really help you if you know what the trend line looks. So never trade. The first rule of trading, never trade against the trend line. Trend line means the trade, is it going down or is it going up? For this case, here the trade was going down. So you cannot buy when the trade is going down until it makes a strong support where there are multiple rejections. I will tell you what rejections are in the next few minutes. Okay, this being the first strategy, it's called resistance and support levels. You can identify the resistance point and you can identify the support points. Okay, let me remove this. I'm sorry for that. Okay, let me remove this, remove drawings. Now let's move to another thing. That is for support, and it can work for weekly time frame, 1 day time frame, any time frame, because you can see this was a let's use the example of this. Let's use the example of this. Sorry for that. Let's use the example of this. This was this. What was this? This was a resistance level, because that is the highest point that trade went. Okay, so it was broke. The trend was broke here. So that means if this was broke, if it's trying to recess here, it can recess for a while and then straight back shoot against that support, that resistance level, and this will be the support level. So the support can be a resistance and a resistance can be a support. You will have to understand this, because this was a bearish, you see, it came and made this support, you see, and then went back, because this being the support, you see, this was a support. Yeah, so when you see a trade breaking a support, that means the trend has changed to another move. Was it a buy? It went to a sell. That, I hope you have understood about resistance and support levels. Now let me go to the other point, a strong rejection. This is the best way and the easiest way to learn about candlesticks. Candlesticks give you a lot of history. They give you a lot of information, a lot of information. What do we mean when we say a strong rejection? A strong rejection means the candlestick tried to move to either upward direction or a lower direction, and then it rejected immediately and closed above that trade. Let me use this. For example, this. Yeah. We have this one. What is this? What is this? Let me draw for those people who don't see. What is this? This is called a rejection. If the trade is on its key levels and then it does a rejection, means the next candlestick, can you understand that? The next candlestick will be a rejection, will be a reversal trend. That, as you can see here, the trend was moving up until this point. You see, this is called a wick, and this is the body of the candlestick. As you can see, the wick is longer on the side. Means the buyers tried to take the price until 2064, and then it was rejected, with the sellers rejected that price to around 2060. That means this rejection is bigger than the lower rejection. Means the next candlestick will have to sell. Understood, guys? If the next candlestick will have to sell, that means you can enter your sell here, sell zone, if that is a key level. Hope you understand, guys. Hope you are understanding. The next will happen. If this, let me look for another one. Let's see. Yeah. For example, of here, the price rejected with a long wick and then went. The next candlestick will go down. That means you can put this as your resistance point, and then you can sell shortly to the next demand point. I will show you how to make that is a resistance point. That is what you call the supply zone. That is where you write this is a supply. This is supply. That is where you write that is a supply. And then let's move. Another rejection that will help you understand. If rejection is stronger on the other side, on the lower side, and it's on its key levels, you should know that that is trying to show you that a demand level is either we are on a demand level or we are approaching a demand level. Look at this. What is this? This is a rejection on the lower side. You see, this was a rejection on the lower side. That means the sellers tried to take this back to here, and then it's rejected and went back up. So that means you can buy at around here, take small profits to this point, and then you move away from the market, because this is a resistance point, you see. And then make sure you are not trading against the trend line. That's why you cannot buy here for long, because this trend line is going down. If it's going down, don't try to mistake and buy long. And buy long. Yeah, you just buy short from here. That is called scalping, you see. And then let's look for a huge rejection which was made like this. This was the best rejection. This here, this was the best rejection. It's confirmed confirmed that this is a demand zone. What can you see about this? What can you say? You see this candlestick, it had a full throttle, full momentum bias, and then sellers tried to bring that to 1909, and then it rejected to around 1919. So this shows that the sellers were rejected by the buyer. The buyers were very, very strong, meaning that this can be your demand zone. This makes it a demand zone. Why? Because it's on its key levels. First of all, you have to understand it's on its key levels. We have a key level here because we see these are resistance point and demand. So here will be our supply zone. Okay, nice one. Let me show you this. Yeah. That shows you that this will be a demand zone, very strong demand zone. Why? Because when we were selling, you can see it rejected the buying. This here, I want you guys to understand, to see. You see this here? This was a rejection. This candlestick with a long wick on the upper side, that shows that trend was going to bearish. That shows that trade was going to sell. So sellers entered here. It rejected the buying price and started moving to the bearish trend. That moving down and down and down. And it made a very strong supply zone. So this was a supply zone. And I told you a supply zone can be a demand zone. So after the reversal, it went to this. The buyers went back to 1932 again, tried to break it. They went back to this, and then sellers tried to bring the prices down to this point, but it rejected. Meaning, when it rejected, that confirms you that is the best place you can buy. And you see, after buying that place, guys, after buying that place, you can see. Let me show you. After buying that place, you see this. Buying that place, what did it happen? You see. That is what it did. It went back up and up and up again. So you can identify using that strategy of strong rejections. Strong rejections means that the candlestick have a long wick, and you should look if the wick is on the lower side or if the wick is on the upper side. If it's on the upper side, showing that they rejected the selling price and it went down. If it's on the lower side, it means that you have to buy because they have rejected the supply zone and it has become the demand zone. The supply zone became a demand zone. You have to understand that. Now the next point is the momentum spike. Now this is one strategy that is used by many people and it's very, very, very accurate. Actually, this is the best you can use. How do we identify a supply zone using momentum spike? Momentum spike will tell you that this is the best way to know if the trade is going up or down. Let's use this. Momentum spike means a candlestick, it's full. It does not have wicks. It is full candlestick, either green or red, identifies a supply or demand. Let's use this. This was a full candlestick with no wicks. That means after this candlestick, it will make the previous. Let's use this. This was the longest. This was the longest. This being the longest candlestick. You see, this being the longest candlestick, it shows that the previous candlestick, which was after a long spike, is the demand zone. We can identify this place as being a very strong demand zone. You see this? That is a very, very strong demand zone. That is where buyers could have entered the market because it showed that is the point. These big people with a lot of money, that is where they entered the market and took the price to here with a full throttle. And then that making it the next point after this. Then we had another full candle, green, and another candle, showing this was also a demand zone. We can make this a demand zone. Why? Because we have to. You must take at least two strategies to make something a demand zone. This was a demand. Why was this a demand zone? First, it was after a long spike. Secondly, it had a strong rejection. Third, it's a strong resistant point of this point, as I told you, of the previous supply zone. So this was the strongest demand zone. Actually, this will be the strongest demand zone ever of gold. If it breaks this strong demand zone, we can take it back to around 1822. So this, using this strategy, you can identify which are the supply zone and which are the resistance in demand zone. Let me show you with another time frame, like the 4-hour time frame. 4-hour time frame, you will really understand what I'm trying to tell you. Let me remove these drawings. Let me remove these old drawings. Let's move to this. What does that mean? I want you guys to understand. After a long spike, we see a demand zone or a supply zone. Let's use this for instance. Here we had a very long spike. The candlestick just before the long spike will be your demand zone. Let's just let me cut it here. Let me cut from there. Yeah, from here. No, sorry. Yeah. Okay, I'm sorry, this thing is trying to bring some. Okay, let me try again the last point there. Okay, you don't have to do that. Now, as I was saying, the long spike after. The long spike, you see? The long spike after. The long spike shows that that thing is either a demand or a supply. Now, let me close that here. Okay, it's okay. I'm sorry for that. So I was saying, after a long spike, the previous candle shows that that thing is on a supply zone, because we can make it. This was a long spike. Now this will be a demand zone. You see that? That is a demand zone, and you don't have to sell. That is a demand zone. Yeah, you cannot, and make sure you will never ever sell against the trend line. Now this, because it's a demand zone and it has already moved up with a very strong spike, you just wait for it to retest the second time. That is where you can put your buy limit at around here, and then you will go long position. You put here your stop loss and your take profit. Sorry, let me do it again. I'm saying here is where you can put your buying area, that point, and then you can reduce the stop loss to where the candlestick ended. Where the candlestick ended. That is the point, and then your profit, you can move it to the next key level, which was around there. You see, when you move it to the next key level, then you can see that what did this trade do? It came here. That was our support level. Let me move that. You can see, what did the trade move? It moved here with a long spike, showing that the buyers have entered the market, then tried to retest again. That is where your activation of trade will be activated. Your buying limit will be activated, and then now you can start enjoying your profits and profits. You see, you can enjoy your profits again, and more. And we can use it at many times. When you see just a long spike, you just have to know this is the demand zone. The same here. This, after this long spike, this will be a demand zone. You see, this will be a demand zone. So you can put your trade here. You don't buy, you put a pending order. What does a pending order means? You just put it a pending order and just wait for it to show. When it will move up, and then it will come back to this support. And then after this support, there are many factors that will make you understand, will you continue buying or will you sell? Because here you cannot buy, because the trend has changed and the market has started moving downward. As you can see here, it moved up, and then there was a very strong rejection here with a full candle. Red means that was a supply zone. You see, this being a demand, it came here and made a supply zone. What did we say? A supply zone is after a very huge spike, because this being a huge spike of a red candlestick, that makes this being the supply zone. And we can move and see this being a supply zone. That was a supply zone. Being a supply zone, you can move it to that point. Yeah, you will just put your selling orders here, because this was a long spike, and just wait for it to come back, and then it will go down, go down, go down until where it went, and then coming here back again, it will activate your sell orders, and then after that is where you will enjoy your fruits. After a long spike confirms that thing is going to buy or it's going to sell. If you have a long spike, you see these long spikes, you have to be very careful with them. Any long spike indicates that that thing is continuing to sell. That was a long spike. That was a long spike, confirming that that trend is still going down and down and down. This is also a long spike. You see, guys, a long spike have a lot of information. The other side, we can move to the other side. Very long spikes confirms that trend is going either down or up. The other thing we can see on the bullish side, we had a long spike here. Yeah, we had another long spike here. You see, and then we have these small spikes. The smaller the candlestick means that the momentum is moving downward and downward and downward. As you can see, the big candlestick move shows that the buyers are very many and very strong. As they are going up, they're trying to reduce. So we can see that we are approaching a resistance level. This is a way to identify if you are approaching a resistance level or you are not approaching a resistance level. So the next point I was trying to say, when to enter the trade, where can you enter the trade? Using the 30 minutes time frame, you can see that where can I enter my trade, where can I not enter my trade. Using this, we can clearly see that here, where if I was asked you a question, between here and here and here, this point here, where is our supply, where is our demand? That is a good question. A good question will be answered with this. After a long spike of a red candle, it shows that is a supply zone. After a long spike of a green candle, shows that is a very demand place. So this is a strong demand zone. Why? Why is this a strong demand zone? Because we had a long spike of a green candle. Green candle shows that is a strong support. That is a strong support, and we can identify this as our demand area. So for people who are entering the market on Monday, you should be very careful with this, because it made a demand zone here, went up again to this point, it made another supply zone here. This is a supply zone because it is just candle after a red candle, which has a very high momentum, the previous candle. That is our supply zone here, and according to the trend is an upward trend. So we can see that this supply zone can be broken easily than this demand zone. So this demand zone, this is the best place to buy. You can buy here and put your stop loss at the last support zone you had. After the last support zone was here. You can put your stop loss at around there. You can buy this area and put your stop loss at around there. That is being strategic. You just don't enter the trade the way you don't know. When you put your stop loss at around here, and then you can enjoy your profits up and up and up. Because I'm very sure the only way it can make you lose is after breaking this demand zone. After breaking this demand zone with a full candle, that shows that trend has changed to be a downward trend. And downward trend you can confirm using the 1 hour time frame and above. 1 hour time frame will really confirm you that, because you can see the other demand zone is around here. This is another strong demand zone. So if it breaks that point, we can wait it to come down at around this place, making another demand zone, and then we can enter our buys. So guys, don't buy and sell anywhere anyhow. Make sure you understand and you have made your limits understandable and you have put your orders correctly. You don't just enter the market the way you want, because the market will not go with your trade. Your trade must go according to the market if you don't want to make losses. The other thing you should know is high versus low quality zones. Low quality zones means that like this. These are low quality zones. Why? Because we have multiple candlesticks which are very short and very brief. Many candlesticks which are low quality, you don't have to buy this point. This point is not a good place to buy, because there is no momentum. The trend can change anytime, anyhow. So this small candlestick, you don't have to buy. You just have to wait for a full candlestick, confirming that is a buy or a sell. Because you can see after this full candlestick, it this was the best place to buy. After this full candlestick, then you can buy this point. It will really make you some more money up and up and up, because you cannot buy at where the multiple candlestick, because you don't know if the trend will change, because that is called an equilibrium. That is where we have supply and demand being equal. And then the last point, why only some zones work? Zones work when the trend, it really depends on the trend. If the trend is going up and it has made a bearish, it is trying to reverse, you must be very, very careful, because in a trend line, there's something called a trend line, because for here we can make this trend line. Trend line is the lows. These are the lowest point, you can see this being a lowest point. You can make your trend line there, and then you can make your highest point. The highest point the trend went was around here, and then around here. No, sorry, not there. Let me put again. The highest point was around, not there. The trend was around, yeah, let's say here. Yeah. The trend line, the highest point was around, let me say here, and then it moved up at around this point. Now, this being the trend, you can see these are long-term trend. The people are buying and buying and buying and buying. So guys, if you are a good knowledgeable person, you don't have to sell on this position, because the trend line is really showing you that the trend is going up and up and up. If the trend is going up, why do you have to buy? Why do you have to sell? I'm sorry. If you sell here, you will really fuck yourself up until it confirms with a strong red candlestick, and it breaks these support levels, and it confirms that it's going downward. So after it has break this is the trend line. After breaking this trend line, and then it continues moving downward, that is where you can put your sales. But before that, we are still on the bullish candle. So guys, if you are trading gold, remember we are still going up and up and up until we have break, we are going up and up and up unless we break this trend line. So guys, don't try to sell gold on long position. If you are selling gold, make sure you are scalping, or either the news has come. If you have understood something, make sure you give me a thumbs up or comment there and ask any question. Thank you for your time. Thank you for everything. Thank you for listening. Make sure you subscribe to that channel. Make sure you share that video to anyone and anyone you know. Thank you for your time. Oh, thanks, Manze.